Today, the Golden Conundrum. Hello again, it's Martin North from Digital Finance Analytics, our latest post covering finance and prop news with a distinctively Australian flavour. Gold has not been behaving as many pundits had expected, given it's seen traditionally as a safe haven and as a hedge against inflation. And as we discussed recently, the US jobs number last Friday was really hot, and that signalled that the Fed will likely continue to hike rates ahead. And yet gold, which typically encounters a meltdown in any situation that calls for stiff Fed rate hikes, and the US jobs report that's more than twice stronger than forecast certainly qualifies as one of those situations, gold held relatively well up under those circumstances. In fact, after tumbling to an intraday low of 1,780 US, which was still higher than Thursday's bottom, the benchmark gold futures contract on New York's COMEX settled down just a notch above that at 1,780.5. That's down $15.70 or 0.9%, and for the week, the COMEX gold was basically flat. And if you look at the spot price of bullion, which is followed more closely than the futures by some traders, well, that was below 1,775 US, down nearly $17 or almost 1% on the day. So one reason for gold surviving the jobs report was probably that neither the US dollar nor Treasury bond yields, which together are the biggest beneficiaries of any Fed rate hike, rallied that much on Friday. And the dollar index, which pits the greenback against six majors, led by the euro, hit a one-week high of 106.81. And on the yields front, the benchmark 10-year Treasury note hit a two-week high of 2.87%. The next couple of weeks will truly test if gold is a safe haven again, said Ed Moyer, analyst at online trading platform Onya. Bullion traders now have two big questions. How much higher will the Fed take rates, and can gold rally alongside a strengthening dollar? The spread between the 10-year and the 2-year Treasury yields fell below zero for the first time this year at the beginning of April. However, it was a little short inversion which lasted only 2 days. But then on July the 6th, the yield curve inverted again, and this time it was more lasting. The inversion of the yield curve has been historically a very powerful recessionary signal. It's preceded all recessions since 1976, eventually. Now, this is a very important development as it strengthens the recessionary signal sent by the curve in April. The previous reversal was very brief and shallow, and thus was not very reliable. The second inversion within just 4 months implies that dark clouds are indeed gathering over the US economy. Now, there are two explanations for the yield curve's inversion. According to the first one, more mainstream perhaps, inversion means that investors expect higher rates now and lower rates in the future as they believe that the Fed's tightening cycle will lead to a recession. The second interpretation is offered by the Austrian School of Economics. It says that because of input price inflation and the tightening of the Fed's monetary policy, entrepreneurs and investors are simply scrambling for funds as they are in a liquidity shortage, which bids short-term interest rates up. But either way, gold tends to shine during economic crises, also during an economic downturn, not least because the Fed is likely to reverse its hawkish stance. When the Fed stops raising interest rates and starts to cut them, maybe gold should rally then. And we can cue at this point an interesting report from Bloomberg which said that gold, according to financial markets law, is a pretty simple beast. For all its complexities, at bottom, what it likes is a weak dollar, turmoil, and lower interest rates. Falls in the greenback mathematically raises the price of dollar-denominated commodities, and turmoil makes investors head for safe haven assets, of which gold is by far the most long-standing, and lower rates reduce the appeal of its main competitor as a haven yield-producing government debt. That makes the activity of money managers of late rather mystifying, they said. Animal spirits appear to be returning to financial markets, paring back interest rates and dollar strength. While US House Speaker Nancy Pelosi's visit to Taiwan is threatening to spark the biggest geopolitical crisis since Russia's invasion of Ukraine. Gold itself has risen about 3.9% over the past 3 weeks. That's its best run since the eve of Moscow's war in February, behaving much as you'd expect. But the funds aren't buying it. In data going back to 2006, money managers have always almost had a net long position in Chicago traded gold futures and options, with more of them betting prices will rise than fall. In just 37 weeks out of 841, has the group been counting on gold weakness. But that's what's been happening in recent weeks. As of July the 26th, their net positioning was short by around 10,474 contracts before bouncing back to a narrow long of 27,899 contracts last Tuesday. Net short positions have only cropped up on a handful of occasions towards the end of 2015 and 18, and very briefly at the start of 2016 and 2019. One possible explanation could be that more and more of the gambling money in gold markets is heading into private hands. There's another group of investors from whom the US Commodity Futures Trading Commission collects data, known as other reportables. Like money managers, they're making macro bets on gold rather than in the physical metals business or trading the spreads between bid and ask prices. Unlike them, they're wagering their own money as family offices, in-house hedge funds, or affluent private clients. They almost always are on the long side of the trade, and in the past 2 years, they've risen to take on a larger share of long positions than conventional managed money funds. The gross long gold position held by other reportables traders, mostly funds managing their own money, is now larger than that of conventional funds managing other people's investments. That doesn't quite explain it, though. While other reportables remain long, they too have wound back their net positions close to their least bullish level since early 2020. Holdings by exchange-traded funds have been moving in the same direction. The mountain of gold that ETF investors piled up as a hedge against uncertainty in the wake of the Ukraine invasion has now been eroded almost to nothing. It's possible that the gap between investor positioning and price momentum is about the behaviour of retail buyers. Jewellery typically accounts for about half of gold demand, and while prices at the moment aren't especially cheap, with trillions of post-COVID savings sitting on the sidelines and inflation approaching double figures, they're looking better value every day. Shares in Chow Tai Fook Jewellery Group Limited, a Hong Kong jeweller with thousands of outlets in mainland China and a decent proxy for spending on trinkets in that country, are currently closing in on their highest levels since November. Macro hedge fund managers, despite their fat salaries, don't have anything like a perfect record in predicting the direction of the market. If you'd bought gold and held it for 12 months in October 2018, when their position was the shortest on record, you'd have ended up with a 27% return. Still, the disconnect between high levels of short interest and bullish price action suggests that something has to give. For a year now, the long-standing and robust inverse correlation between gold and US Treasury yields have been breaking down. If that relationship returns to something like normal, we're going to see either a sharp fall in interest rates or an equally large drop in the yellow metal. Now, the point about all this is that gold is not behaving the way people would expect it to behave. And that's a concern for many, because effectively one of the eternal verities was, in gold you can trust. But the point is, there is significant risk ahead that gold is going to continue to fall, particularly if rates come back later. So I suspect that explains quite a lot of those positions, but I want to underscore again, we're talking here predominantly about the various derivatives contracts that sit around the gold price. And the 1 to 50 relationship between the underlying and all of those contracts explains the fact that many people are taking positions not to own gold or hold gold, but simply to speculate on future movements. And bearing that in mind, you've got to say the trajectory of gold ahead is probably down rather than up. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.